If we had this conversation 10 years ago, we'd say, man, it's looking bad. The future, the world's going the wrong direction. There could be war. In Europe, they could close the Straits of Hormuz. Gold might go to $5,000. Well, that's where we are. So maybe the money, hard money, real money markets sniffed out the direction of the world and priced some of it in advance. That would certainly fit the pattern we've seen since January. Many, many different directions we can go from there.
$4,700 does not feel like down to me. So it's really a function, I guess, of your time frame. The second thing is that in my experience, I'm not a gold historian, but in my experience, I guess I'm old enough to my experience is history, but in my experience, what really moves gold isn't geopolitical fear, but rather fear about the deterioration of the purchasing power of one's savings, expressed primarily in the world's reserve currency, the US dollar.
Gold and silver prices hit their highest levels in weeks after the United States and Iran announced a 2-week ceasefire deal, though analysts have said whether the rally lasts depends on how secure the agreement is. ING analysts told the Wall Street Journal trader sentiment about metals is showing signs of stabilization, though they noted gold prices are still down about 11% from February as the Iran war weakened its safe haven appeal. Veteran investor and seasoned resource sector analyst Lobo Tiggre and RickRule are widely known for his deep expertise in mining stocks, precious metals, and contrarian investing strategies. In this video, Lobo Tiggre explains that criticism of gold's current performance misses the bigger picture. He emphasizes that rather than signaling weakness, gold is doing exactly what it's meant to do, serving as reliable, liquid money, even for governments that may need to tap into their reserves during periods of stress. Looking ahead, Tiggre suggests that if the conflict drags on, gold and silver could respond through 2 distinct paths. In a more extreme scenario, he explains that safe haven demand would overpower all other influences, driving strong buying in the metals. Meanwhile, RickRule explains that gold's performance depends heavily on time horizon, noting that from a long-term perspective, current prices represent a massive gain. He mentions that gold is less driven by geopolitical fear and more by concerns over declining purchasing power, especially linked to currency debasement, while Rick stresses that gold's primary role remains preserving wealth over time, not reacting to every short-term crisis. If you're ready for unfiltered truth and sharp market analysis, hit that subscribe button. Let's explore the latest insights from Lobo Tiggre and RickRule's recent interview.
First off, gold futures are just about 4,700. They're actually slightly up today as we're recording, and this threat is hours away from a taco or something pretty ugly happening, or glorious, I suppose, depending on your perspective. But are you kidding me? We're going to whine and complain about $4,700 gold? What is wrong with the gold? It should be $2,000 if it's going to predict war and disaster and chaos in the world. I mean, really, take a breath, think back. If we had this conversation 10 years ago, we'd say, man, it's looking bad. The future, the world's going the wrong direction. There could be war. In Europe, they could close the Straits of Hormuz. Gold might go to $5,000. Well, that's where we are. So maybe the hard money, real money markets sniffed out the direction of the world and priced some of it in advance. That would certainly fit the pattern we've seen since January. Many, many different directions we can go from there. But sorry, one more quick point. When push comes to shove, the ultimate source of liquidity is also hard money. And we've seen that, I don't think just for investors, Rick's doing a bobblehead, but we've seen it for sovereigns, right? The famous report of Hungary selling off like its last several years worth of gold purchases to help offset the energy bills. And we understand other governments are doing that too. So this isn't gold's failure. This is gold doing its job. The scarier it gets, the more the safe haven demand really, I think, starts trumping other considerations. Whether the Fed might cut or raise by 25 basis points is really a small consideration when you're worried about maybe having that thermonuclear war insurance triggered. It's a completely different consideration. But let's say that we don't go there. We're not talking Armageddon here. We're just talking bad news for a protracted period of time. I think there's absolutely no way this is not inflationary. And I'm not Mr. Predictions. I'm not Mr. Bold, whatever. I'm trying to be level-headed, as you said, I'm trying not to wave my arms too much and say what must be, what will be. But this is when I'll go out on a limb on and say, I see absolutely no way this is not inflationary. And that will be reflected in all real assets that governments can't print. But I think it will be reflected quite strongly in monetary metals, which in my view is only gold and silver, not platinum and palladium.
Well, I think Lobo made some great points. I'll try to summarize them, maybe editorialize a little bit. As he points out, whether or not the gold price is up or down depends on your time frame. I began saving in gold in the year 2000 when gold was at $253. $4,700 does not feel like down to me. So it's really a function, I guess, of your time frame. The second thing is that in my experience, I'm not a gold historian, but in my experience, I guess I'm old enough to my experience is history, but in my experience, what really moves gold isn't geopolitical fear, but rather fear about the deterioration of the purchasing power of one's savings, expressed primarily in the world's reserve currency, the US dollar. The US dollar has been very strong in the last 6 weeks. The events in the Gulf have strengthened the US dollar at the expense of secondary currencies. Given that gold is quoted in dollars in the near term, that's negative for gold. Third, as Lobo suggests, gold has done its job for sovereigns. The Turks had to defend the Turkish lira as an example against a strong US dollar to maintain pricing levels in Turkey. What did they have that was marketable? Certainly not Turkish bonds. Gold. They did what other holders of gold do during periods of time when they need liquidity, because gold offers liquidity. And to summarize, and Lobo got this right too, it will all depend on how the conflict is financed. And my suspicion is that the conflict will be financed in a whole bunch of countries through currency stimulation, which is to say artificially low interest rates. Nothing in the world can make you more concerned about the maintenance of your purchasing power than a government guarantee that you're going to lose it. Specifically, deposit interest rates that are substantially below the rate of the deterioration of the purchasing power of the relevant currency, including the US dollar. Now, in the very near term, it could be that war causes additional liquidity concerns. And that could be negative for the US dollar. There's all kinds of countries around the world. They're going to need access to cash. There's all kinds of countries around the world with secondary currencies that will need, at least politically, to defend their currency's purchasing power to the benefit of their voters. And that could be difficult for gold. But you're talking about a circumstance that doesn't take into account gold's real role, which is the maintenance of your own purchasing power over time. To me, and I think Lobo, I don't want to speak for him, but precious metals utility for us is not as a savings vehicle. For me, at least, I save in gold. I maintain liquidity in US dollars. I speculate in silver. All different functions. And for me, I'm completely sanguine about my gold holdings. By the way, I'd love to be wrong. The set of circumstances that makes the gold price go up is invariably difficult on other parts of your standard of living. At age 73, I would prefer to have a mellow life for the rest of my time on Earth, even at the expense of the nominal price of gold held in my portfolio. I don't believe that that's something I'm going to experience, however.
Seasoned investor Lobo Tiggre points out that although many gold and silver mining stocks seem attractively priced, investors shouldn't rush in too quickly. He notes that because mining stocks act as leveraged plays on gold and silver, any decline in metal prices can lead to even sharper drops in these equities. Regarding the mining sector, RickRule states most mining stocks have little real value, with only a small group of high-quality companies worth owning. Rick warns that in a broader market downturn, even strong mining stocks can fall sharply, emphasizing the need to hold cash and wait for better opportunities. Increasing production costs play a crucial role. As mining companies face declining ore quality and higher expenses, the average all-in sustaining cost is approaching $1,600 per ounce. This raises the minimum price needed for profitable mining, providing a natural floor for gold prices. For investors, this means market volatility can present buying opportunities, as prices are unlikely to fall below these production thresholds. Ultimately, gold's journey above $4,800 is driven by persistent central bank buying, a tight silver market, and rising production costs. As focus shifts from short-term news to these fundamental trends, the bullish outlook for gold becomes increasingly compelling. Let's jump into the interview.
If you've got some bargain in gold and silver right now, Mr. Market is telling you there's something wrong with that company, and you ought to pay attention to that. I'm not saying there's been no drawdown. There certainly has been a response. And, many people, present esteemed company included, have pointed out how undervalued or record low values we have on some of the best producers and companies in this space, priced in real money. And it's not just priced in real money. If you're a gold miner, then gold is actually quite relevant to your valuation. So I think there's a double case to be made for looking at the companies in terms of this commodity they produce. And in that lens, they are on sale. I get that. I don't dispute that at all. My only point has been, if the metal itself goes into reverse, this wonderful fundamental, this undervaluation case is not going to prevent the stock from retreating with the metal. We all know they give us leverage to the underlying commodities. In January, when it was doing, I've been criticized for doing the mirror thing wrong on videos. When the stock was going hockey stick vertical, right? And people were saying, oh yeah, the stocks are still undervalued, they're going to the moon. And my thought was, yeah, but when the correction comes, there's always a correction. Nothing goes straight up forever. The stocks will not be exempt. So that's my view right now. I'm not saying I wouldn't be happy to buy more on sale. I'm saying the current minor retreat really is not a sale in my view. And I would love to have that opportunity to back up the truck and load up again on these stocks. I just don't think we're there yet.
I would suggest to you that 90% of the mining stocks listed worldwide are valueless. They have no value whatsoever. So if you're looking at the market overall, it's perpetually overvalued because most of them are pretenders. If you then segregate for the 10, I think the situation becomes very different. I am one who believes over the next 10 years that the US dollar loses 75% of its purchasing power. I think it's more likely than not that the nominal price of gold, the US dollar price of gold, maintains its purchasing power, which suggests higher gold prices over 10 years. I'm not talking about 3 months or 6 months because I don't know. I don't know about 10 years either. I'm just assuming that it is higher rather than lower. By that metric, there's lots of room in the gold stocks, provided that one is willing to accept two risks. The first is that they're wrong about their gold price thesis. There needs to be room in your portfolio for being wrong. Because nobody's right all the time. Even Lobo or I occasionally make missteps. The second thing is that we need to remember that stocks are stocks. And gold stocks are also stocks. If we have a circumstance where concerns about the war, concerns about the deterioration of credit quality on a global basis, things like that lead to a liquidity squeeze, a 2008 liquidity squeeze. Believe me, if we have a sell-off in equities, it won't be confined to equities that you think are less important. The sell decisions will be made by the margin clerks, not by the speculators. And there will be no floor, or at least no comfortable floor below this stuff. So own the stuff the way Warren Buffett says. Own the stuff because you like it so much that you would welcome a 50% share price decline so that you could buy more cheaply. That is a measure of love that very few people understand. And I think the fact that they don't is responsible for an awful lot of the investment underperformance that we see across financial markets. I personally have a shopping list. And I am looking in particular now, I have emphasized for the last while very high quality companies. And I would say by now that my portfolio is, let's say, overstuffed. At the very, very, very peak of companies. What I'm looking for now is companies that have reasonable valuations, and companies that would be logical acquisition candidates for other companies, where I either get valuation arbitrage between the multiples paid by the biggest and the best, or I see the biggest and the best take over the smaller companies. I'm looking for single asset producers where the single asset discount would disappear if they got taken over. I'm looking for assets that are really truly synergistic with somebody else's infrastructure. I'm not gobbling, but I'm certainly nibbling. And I would look forward to a massive share price decline so that I could take advantage of that. With the caveat,
Jesse, I know you've got other questions, but let me. Sorry,
I don't want this to be an excuse for people to look at the great unwashed, to look at the 90% of stocks that are valueless and feel okay about buying these pieces of you-know-what because they're within 200 miles of a producing mine or something like that. It's important that you remember the fact that 90% of the listings have no tangible value.
Lobo. I'm going to tag on to that if I may, Jesse.
Yeah.
Agreed. And, Rick is being very circumspect and careful here and not promising anything, especially in the near term. But I want to say that, with the chaos and the fog of war being one thing, with the, he mentioned credit quality, but I'll be a little more specific and say the growing concern over private credit. Like, even if that is fundamentally sound at some level, just the increasing level of panic there is the sort of thing that could become a self-fulfilling prophecy and cause maybe unnecessary harm, but it's still harm. So I'm not predicting the crash of 2026. Let me be very clear. I'm not making that call. I'm just saying the pieces are on the table right now that could lead, panic triggers, panic, stops get pulled, things start waterfalling, that sort of thing. I'm not talking a non-trivial chance here. It seems to me the pieces are on the table for a serious market event this year. If that happens, wouldn't I want to have a lot of cash to take advantage of it? It's one thing to have conviction of your and courage to act on it. It's another thing not to have money. I remember one of the most painful experiences in my career was in 2008 when all the people who saw what was happening, they agreed, they got it. But then when the opportunity presented itself, I remember the agonized email from people saying, I get it, I want to buy, but I'm all in. I have no cash. I recently got a lot of more rotten tomatoes by telling people that I was rotating out, not of gold and silver, haven't sold an ounce of bullion, but I sold almost all of my stocks. I even sold, gasped, Mr. Rule, my Wheaton, Franco, and I'm blanking, Agnico. The cream of the absolute cream. I bought them at cyclical lows. We were near cyclical highs. I took the money. If we get this waterfall event, this will set the stage. Like, I have 10x'd my cash to invest since inception 8 years ago. And if I have that much more to deploy now in such an event, it will set the stage for much more interesting things to come for me. And if not, the volatility that we see, there's going to be something to buy, whether it's selective, stocks like Rick is talking about in the gold and silver space, or rotating into oil on the end of the war, an oversold condition there, or copper or uranium. The chances that there's nothing for me to buy this year, I think, are basically zero. And I am cashed up and loaded for bear, maybe a bear market. We'll see what happens.
In summary, gold's push toward $4,800 is shaped by the interplay between structural demand and central bank buying on one side, and dollar strength and Fed policy on the other. Traders should closely monitor Fed announcements, dollar movements, and the $4,800 technical level to determine which narrative will drive the market in the weeks ahead. Are investors focusing too much on short-term price swings, or are they missing the long-term forces quietly pushing gold and silver toward even higher levels? Let us know what you think in the comments. If this video brought you any knowledge, give it a like, subscribe, and ring that bell so you're always in the loop. See you in the next video.